Types of consideration. See, whenever we buy big assets, example car, refrigerator, or maybe a huge machinery, there can be a possibility that we might not pay entire amount upfront in cash. Example, if you want to buy a car of rupees 10 lakh, you won't pay entire 10 lakh rupees as a down payment, as an upfront payment. What do we normally do? We pay 2-3 lakhs as an upfront payment and remaining amount is taken as a loan. Similarly, when parent is acquiring subsidiary, they might not pay entire amount upfront then and there. They might give it in kind or maybe promise later, maybe take a loan, etc. So when the consideration is not straightforward in cash, instead multiple components of consideration is there, how to calculate. If asset is transferred, let's say you have purchased a subsidiary, acquired subsidiary, and in return given land and building as a consideration in kind, we will take fair value of asset transferred as consideration. Example, you have transferred a land and building, then we will take fair value of land and building as consideration. Assets transferred by the acquirer, example, fair value of asset transferred as consideration. Example, they borrow loan, they raise funds, maybe borrow loan, debentures, loan stock. We will take fair value on date of acquisition. On date of acquisition, got the liabilities, that value will be taken. Equity interest issued by parent, equity shares issued by the parent. We will take fair value of issuer company, parent company on date of acquisition, and later we will record as share capital and share premium. We will have to record this as share capital at face value, and extra amount will be treated as share premium. The point is, if shares are issued, we will have to take fair value of the parent company, issuer company. Many a times they will give you fair value, market value of both parent and subsidiary. We have to be careful and wisely, carefully use the fair value of the issuer company, fair value of the parent company. Next, deferred consideration. The consideration is not paid upfront. Instead, entity says that do not worry, subsidiary, I will pay 1 year later, 2 years later, 5 years later. There is a deferment. We will calculate present value of the deferred consideration on date of acquisition and record it as a liability. Contingent consideration. The parent might say that subsidiary, if you achieve a target of 1 crore, okay, or maybe 10 million of sales, then we will give you this and this extra consideration. If you achieve a target of profit, maybe example dash and dash, then you will get an extra consideration incentive. This is contingent. Contingent means you don't know the certain amount. It's not certainty. Instead, it is dependent on future events. It is dependent on future events. If that particular sales target, profit target will be met, then this consideration will be given. How do you record? We will calculate fair value on the date of acquisition. If it is asset transferred, calculate fair value. If it is liability, calculate fair value. If it is equity shares, calculate fair value using the fair value of the issuer company, parent company. If it is deferred consideration, calculate present value. If it is contingent consideration, calculate fair value. Okay. Any questions? Please confirm. Any questions?
Hello.
Yes.
Uh, what's the difference between deferred and contingent consideration? Like both
Deferred
the
means
nature
it.
of yes.
Okay. Deferred means you have a certainty that you will make a payment. Example, you take a bank loan. All right. This is kind of a deferment. You take EMI option on your credit card. This is what? You're not making entire payment today itself. Instead, you are putting it into installments. Okay. This is deferment. You're not paying today, but you are paying in 3 months, 6 months, 1 year, 5 years, some period extended. Okay. Postponed, deferred. Contingent, you are not sure if whether it will be paid or not. Okay. It might be zero. It might be something. Example, if you complete the project within this and this, you will get an extra bonus. Correct? An incentive. Similarly, they can give a target that subsidiary, if you achieve a target of this and this sales and revenue, we will give you this and this particular amount. The point is, it is dependent on a term and condition. Okay? A target based.
Okay.
Right? Okay. Under deferment, it's a confirmation that you will make a payment on a certain date. Contingent, it's not a confirmation. It all depends upon the happening and non-happening of a said event. Ma'am, we are discussing these points from the parent's perspective, correct? From the payer's perspective, acquirer's perspective, issuer's perspective, the investor's perspective. Who will pay consideration? Obviously, the buyer will pay consideration. Who will pay consideration? Investor will pay consideration. Okay, who is buying car? Obviously, the buyer will have to pay the consideration. So, same way. Yes, we're talking about these consideration from the perspective of investor, or you can say parent company. Let's try an example. Question number 1. ABC acquired 300,000 of DEF's 400,000 ordinary shares. Please tell me, what is the percentage of holding? Parent has percentage of holding. What is the percentage of holding?
$75.
75. Correct? 3 lakh shares divided by 4 lakh shares. Correct? Into 100. We can say 75% holding. We can easily say NCI equals to 25%. Ending on 20th February 2005. So you have to be very little, I would say, very clear about the financial year. So it's on 28th February 2005. DEF was purchased from its directors who will stay in the company, who will remain in current roles in the business. So as an accountant, we cannot record managers and directors, their, I would say, entry and exit, correct? It's a qualitative information. We cannot pass any journal. We cannot recognize. Next, the purchase consideration comprised of 250,000 in cash payable at acquisition. So this is cash payment, upfront payment, 250,000. Exact same amount will be taken for PC calculation, purchase consideration calculation. Then we have 88,200 payable 2 years after acquisition. Herein they have promised that we will pay 2 years later. If you are not paying a consideration to itself, instead you will pay 2 years later. This is which kind of consideration? If you're not paying today itself, instead you will pay 2 years later. Which kind of consideration? Amit and Chandar says deferred.
Deferred.
Deferred, correct? You are deferring the amount. You are saying I am not paying today, instead I'll pay later. So we will have to calculate deferred consideration. And deferred consideration is recorded at present value. Absolutely correct. So we will have to calculate 2 years present value factor and multiply our 88,200, and that's how we'll get to know the present value. Next, $100,000 payable in 2 years time if profits exceed $2 million. This is which kind of consideration? Can we say contingent consideration because they are not paying? Okay, there is no certainty. It is dependent on a condition that if subsidiary will achieve a profit target of 2 million, then this ABC company will make a payment. Can we say this is contingent consideration? Chandar and Amit, I'm only getting 2 answers. Neha, Kiran, Pavan, Chittaranjan, Dipankar. How do you record this contingent consideration? At contingent consideration is recorded at fair value. Correct. At fair value. Okay, contingent consideration is recorded at fair value. Then we have equity shares issued in ABC at acquisition on 1-for-3 basis. Please tell me how many shares have been issued. I want everybody to calculate 1-for-3 basis. How many shares have been issued by ABC? ABC promises to issue how many shares? One lakh shares. Okay. I've got 2 answers and they say 1 lakh shares. 1-for-3 basis. For every 3 shares acquired, they will issue 1 share. How many shares acquired? 3 lakh shares acquired. Correct? 3 lakh shares acquired. Out of this 3 lakh shares, for every 3 shares, they are issuing 1 share. How many shares acquired? 3 lakh shares acquired. For every share acquired, for every 3 shares acquired, they are issuing 1 share. Now, we will have to take fair value. Fair value will be taken of ABC company or DEF company. Fair value will be taken of ABC company or DEF company. We will have to take fair value of ABC company, correct? Of fair value of issuer company, parent company, ABC. So whatever fair value is given, let's say fair value of both the companies are given, we will take only of ABC company. Then the consideration payable in 2 years after the acquisition is a tough. This 2 million contingent consideration target is really tough, and thereby it means that fair value is taken and has been measured 30,750 given. The market value of ABC company is given 7 0.35. We can take this. And appropriate discount rate is given 5%. Can I know present value factor of 5%? Can I know the present value factor for second year using 5% discounting rate? Correct. 906, 907, 91, all are correct. We can write 0.907. Okay, something like that. 029, something like that. And so on. Okay. Now the question is asking what is our cash consideration, what is shares, and what is total. Let's try. What is our cash amount? Cash amount will be recorded at exact same amount which is given in the question, and cash consideration equals to 250. Cash consideration equals to 250. Straightforward. 250. Then deferred consideration. Deferred consideration equals to 88,200. So we will have to calculate present value. And how do you calculate? 88,200 multiplied by present value factor. 1 divided by 1.05 raised to the power 2 years. Tell me the amount. If you calculate this in this manner, you will get the same answer. 88,200 multiplied by 1 divided by 1.05 raised to the power approximately 79909. Can we say approximately 80,000? Okay. Contingent consideration, we will have to take fair value. Contingent consideration fair value is given in the question. And contingent consideration fair value is given in the question, which says if the target is tough and the fair value has been measured 30,750. 30,750. And how we will be able to determine the future fair value in case of contingent? Question says, okay, you will be getting the question and they will tell you the amount. You just have to be sure that, okay, we have to pick up the fair value. In real life, we require proper calculations, estimations, past experiences. Number of shares issued, we have to calculate fair value, correct? How many shares? 300,000 shares acquired. And out of this, it says that for every 3 shares acquired, they are issuing 1 share. For every 3 shares acquired, they are issuing 1 share. And the rate per share equals to 7.35. The market value per share equals to 7.35. Tell me the amount. 735. Correct, Amit? Ravinder? Bhavin? Correct? 735. Good, good. Kiran? Pavan? Dipankar? Harikrishnan? Okay, fine. Can we say our total consideration is this? Cash consideration equals to this plus this plus this. These all are cash consideration. Maybe it might be paid today, tomorrow, doesn't matter, but it will be paid in cash. Consideration in shares equals to 735 and purchase consideration total equals to Now, later you will come to know this 735 in the CFS will be distributed between share capital, okay, at face value. Right now, the face value is not given. Share capital at face value and extra balance in figure. Figure will be taken as share premium. Balance in figure will be taken as share premium. Share capital will be written as face value, and balancing figure will be taken at share premium. Okay, later when we will prepare the CFS. Okay, are we good till here? Any question?
Ma'am, contingent liability. Can you explain once again?
Sure. Contingent liability means example. Okay, we must have heard it from our parents, and we tell to our kids also that if you achieve example percent, we will give you a new bicycle, or maybe a new, I would say, a toy, something like that. Do you agree? A new bicycle is dependent upon 90% score. Okay.
Okay.
This is contingent. What is this?
Okay.
Is it promise? Like, do you agree? If they
It
score
is a
lesser, they
promise,
will not get the. Sorry.
not get it. Oh, okay. Understood,
Okay.
ma'am.
It is
That is
correct.
promise.
It is a promise,
If you
but it
need.
is conditional promise. It's a promise, but there is a
Okay.
target given. If they achieve that target, they will get that done. Okay. They will.
Okay.
Okay. In a similar way, parent says that. Read this again. 100,000 is payable in 2 years. After 2 years, 1 lakh will be payable. 100,000 will be payable. If subsidiary's profit exceed 2 million, if subsidiary is able to meet a profit target of 2 million, they will get extra consideration of $100,000 from parents' pocket. Yeah?
Okay.
Okay.
Clear, ma'am.
It is contingent, dependent on happening and non-happening of some event.
Okay.
Okay. So herein we need to calculate
Okay.
fair value. Now, how can we calculate fair value? So our for question answer purpose, they have given that the fair value can be estimated, measured at 30,750. So we have taken fair value on the basis of given case study.
Okay.
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 All right. Any question? Chandar, any question? Ma'am, what's the journal entry for purchase consideration allocation to share capital and share face value? To share capital and to share premium. It is directly recorded. Or we can say example, sometimes it depends. See, if you have created a payable or not. Let's say if there is a payable, then you will debit the payable debit to share capital and to share premium. Okay, all right. So we are done with question number 1 and 2. Anything that you wish to ask? Any other pointer? Okay. If there is no doubt, we have understood this. There is one thing known as unwinding of discount. See, during deferred consideration, we will record a liability. Okay. During deferred consideration, we will record a liability. Example, in the given case, it is happening on 28 February 2005. Okay. Acquired on this, and year is ending also on this. Now, on 28th February, okay, there will be a journal entry. Net asset, okay, to deferred consideration. Provision, or you can say liability. I'm writing over here debit and credit. You will record at 80,000 and you will record at 80,000. Okay, how did you calculate? 88,200 into 1 divided by 1.05 raised to the power 2 years present value factor. So that's how you have got 80,000. Now, this is 2005. 2000. Let's say 2005. Next, on 28th February 2026, again you will pass a journal entry. Since it's a liability, do you agree it will have interest? Since it's a liability, do you agree there will be interest charged on this liability? So we will say finance expense debit to deferred consideration liability. What is the amount? You will say 80,000 into 5% into 12 by 12. Right now it is for 12 months entirely. 4,000, and this equals to 4,000. Now, on next year end again, because it is for 2 years, again you will pass a journal entry. Which will be same. Finance expense debit, because it's an interest, because it's a liability, it will have interest expense in the P&L. How will you calculate? Equals to sum 80,000 plus 4,000. 80,000 plus 4,000 into 5%. 4,200 equals to 4,200. Now, your liability equals to 88,200. Now, on let's say 1st March 2027, when you will actually make a payment, your journal entry will be deferred consideration liability debit to bank 88,200 and 88,200. This is known as unwinding of discount. And it increases the expense and decreases the profit. It increases the liability. It increases the liability. It increases the expense in P&L. Give me a quick thumbs up. Are we clear? During the post-acquisition period, unwinding of discount will take place during post-acquisition period. You will have to unwind the discount on the liability during post-acquisition period. Okay, are we clear? Please